In 5 years, there are not going to be fintech companies anymore. All of them are going to be traditional finance rails and also crypto companies. So Robinhood, Revolut, Prix, and all of those players will be implementing like blockchain-based solutions. And there's going to be this inflection point that those financial institutions that will not use blockchain will just be at a disadvantage. Distribution is global. It just makes sense that over time, those that will tap into the technology will have advantage over the others. New York Stock Exchange announced their project of native tokenization of stocks. I would say right now, we are at around 2005 when it comes to expansion of the internet in the blockchain realm. So it's a perfect momentum for learning and trying to get that osmosis because it doesn't happen like overnight.
Hello, welcome back to Odys Podcast. My name is Aneta Samkov, and today I'm meeting at Consensus in Hong Kong. And my guest is Marcin Kaźmierczak, who's a co-founder of RedStone, which is the second largest blockchain oracle in the world. Marcin is also 30 under 30 Forbes list. So we're very excited to have you here. Thank you for coming.
Thank you very much for inviting. It's lovely to be over here and looking forward to our conversation.
Awesome. Yes, the topic for today is on-chain adoption in practice. So, Marcin, for listeners who may not be fully familiar with your background, you've been deeply involved with building the Polish and European blockchain community and ecosystem from ETH Warsaw to RedStone. How did it start, and how did that journey shape how you think about crypto today?
Yeah, that's a very good question. I started in blockchain industry in late 2017 when I was writing my bachelor thesis about blockchain, Ethereum, and applications that can be created on top of the decentralized technology. Then I worked in a first startup in that industry in 2018. Unfortunately, a startup went down and I didn't get 3 months of salary. That was like a pretty tough beginning. But thankfully, I stayed within this industry because I saw huge potential, especially in the finance and economic world. I graduated quantitative methods in economics. So my background is mainly statistics, understanding how monetary policies work like, and cryptocurrencies are very much around that realm. In 2020, we started RedStone as the Oracle business. I left Google Cloud to pursue the startup together with Jacob and Alex, the two co-founders. And then in 2021, that's after COVID, conferences came back to day-to-day life. We went to ETH Lisbon in November 21. And we realized that many of the people that build in crypto are Polish.
Oh, really?
And we didn't even know that. And when we learned that there are so many Poles that are creating strong projects globally, we were like, okay, let's create community and a movement in Poland that would spearhead the blockchain adoption and also new creation of new startups and implementations in our country. So that's how ETH Warsaw started.
Yeah, you saw crypto develop through early experimentation stages through being adopted by institutions. At what point did you realize that it's really the institutions that will drive the on-chain adoption?
Yeah, so here I want listeners to understand that majority of industries as we interact with are globalized already. When we listen to music, we go to Spotify. When we watch video, we use Netflix. We want to eat some mainstream food, we go for sushi, pizza, or kebab. Like everyone knows that because it's globalized. But when it comes to finance, how it operates in Singapore, Hong Kong, as we are here today, Poland, the UK, or United States, it has been very fragmented. And the reason for that is financial world has been developing over decades in separation from each other. So the United States financial system was created separately from the French one, from the German one, from the Singaporean one. So you can imagine that the silos in all of those regions like were created. And then on top of those silos, people were trying to create some connectors. And those connectors are, for example, SWIFT, SEPA, Stripe. So a lot of like fintech companies are trying to connect those systems that inherently were separated from each other. And now blockchain offers you truly globalized and decentralized system that has no borders, works 24/7, so it doesn't matter what time zone it is in. So you can just imagine, instead of having silos that are connected with each other, you create one unified layer for the whole global finance. So this creates so much more efficiency when it comes to transactions globally. For example, you can send stable coins right now to any place in the world, like for a couple of cents and within a second, instead of like waiting long time. And secondly, the whole transaction cost of operating as an individual, but also as an institution, is decreasing dramatically. So it's just more efficient and easier to adopt technology over a long time. And I'm extremely positive that finance, as it is right now, will be running on both the traditional rails and blockchain ecosystems in the coming years. And here, a strong prediction, you can count on that one. In 5 years, there are not going to be fintech companies anymore. All of them are going to be traditional finance rails and also crypto companies. So Robinhood, Revolut, Prix, and all of those players will be implementing like blockchain-based solutions.
Oh, very interesting. So for people outside crypto, can you actually explain in simple terms what are oracles and how they fit into the infrastructure and the adoption?
Yes, that's a very good question and not an easy one. So I would try to do my best.
Okay.
Blockchain, there are many blockchains. We have to start with that. So there's Bitcoin blockchain, there's Ethereum blockchain, there's Solana blockchain, there's Avalanche blockchain. And those, as I was explaining before, those blockchains are unfortunately also silos from each other. So when I was talking about financial systems, those systems were associated with a specific country. And here we have blockchains that just decided to build separately from each other, like, Avalanche, Ethereum, Solana. They natively don't have like any connection to each other, and they don't have connection to the external information that is from regular world. So they cannot, for example, query Google or internet for some information. Then require a service that is delivering, like injecting the data to that particular blockchain. And this infrastructure that is delivering the data feed is called an oracle. So an oracle, as RedStone, for example, is a system that aggregates data from plenty of sources, 500 of them right now we have. It's about market information, so prices of commodities like gold and silver, stocks, so Tesla, Coinbase, and so on, Forex, so international currencies, but also crypto assets, so Bitcoin, ETH. It's mainly about the price, but also many other market information. We aggregate that as a system, and then we deliver it to the blockchain ecosystem so that people can build on top of that. And the most common use case are smart contracts. Smart contracts are autonomous contracts that execute based on the input. And to explain it in simple words, it's nothing else than if that, do that. So you need an input, something that is going to trigger a sequence, and then you need this execution to happen. And this input can be this oracle data. So in example, if Trump wins election in the US, do that. If Bitcoin crosses $100,000 per one Bitcoin, do that. So it's just like this piece of infrastructure that is delivering the data before execution on-chain happens.
Okay, I see. So why are they so important?
So they allow the systems to work without any problems, because usually those smart contracts are used to create DeFi solutions. For example, Pendle, Aave, Compound, Morpho. So all of those big applications globally in decentralized finance are relying on smart contracts that execute based on Oracle price feeds. So you can think of Oracle as this trust layer that is going to deliver accurate data, because if we deliver inaccurate data, the smart contract is going to execute with problems, like unrightfully. So we are this layer that ensures whatever is going to be delivered on chain, the actual logic is going to be executed without any problems. Maybe one comparison I can share with the listeners is Bloomberg. So in financial world, people rely on Bloomberg data for financial applications to execute. And similarly in on-chain finance and in blockchains, oracles is this piece that delivers the data similar to Bloomberg in finance.
Okay, so it's like a data provider.
Exactly. But like an aggregator of data providers, because it's not that we just have one data that we take from. We have 500 sources We aggregate,
Okay.
clean it, and then deliver it.
So you also do the cleaning and the data management.
Processing, yes.
Okay. Oh, very interesting. So you've said that this year is a year of tokenized finance, and I can kind of also hear it throughout the conference. What changed recently that made this moment feel different from the previous cycles?
Yeah, that's an excellent question. I believe it's been an ongoing process with the largest financial institutions in the world expanding into on-chain environments. For example, BlackRock, which is the largest asset manager in the world. They have over $10 trillion of asset under management, launched a tokenized version of T-bills, BlackRock Bill, so people can have access to yield from Treasury bills from the United States globally. For example, I'm from Poland, and getting access to Treasury bills from the United States is not so easy in Poland. Like you need to have like Interactive Brokers or some other broker to create an account, and then only then you can have an exposure. With a tokenized fund like BlackRock Bill, Vanek Vibil, and many other tokenized versions of money market funds, you can have access to that with a simple click in a wallet. So in a wallet, I have, for example, USDC, which is a stablecoin on Ethereum or Solana blockchain. And then I can just subscribe to a specific tokenized version of Treasury Bill, and I get access to that. And there is not that much fees involved in the whole process. So you can think of it as an ultimate global distribution for financial products. Second reason is there is much more clarity in the US when it comes to implementations of blockchain applications and like how the regulators are looking at those. Within the previous cabinet, there was quite a lot of scrutiny from SEC towards like blockchain implementations. But right now we see the terms being very favorable. To give you tangible points, in December of last year, 2025, DTCC, which is the largest transaction processor and counterparty in the world, they process, I believe, over $3 trillion a year of assets. Wow. They got a non-action letter from SEC to pursue tokenization projects in the United States. And not that much later, I believe like 3 weeks later, New York Stock Exchange announced their project of native tokenization of stocks, which will allow people to use stocks on chain. It's not clear yet from their announcement which blockchain they are going to use, but it just shows the largest players in finance in the US are actively pursuing those kind of projects. And what's changed? Honestly, not that much else. It's just for institutions, it takes quite a long time to implement those endeavors. In crypto, people have ADHD, so they expect things to happen within a day, maybe a week. Whereas in institutions, it happens in quarters, sometimes maybe even years to make something implemented because of the legal, because of the large structure. But the most important is you can think of this finance going on chain as a wave. And I believe we are still in the very early phase of that wave. And there's going to be this inflection point that those financial institutions that will not use blockchain will just be at a disadvantage. Because here is a very simple calculus. If costs on blockchains are cheaper, and this is a fact, it's not like a speculation, it is clear that transmitting dollars, so stable coins across globe is cheaper, operating funds on chain is cheaper, distribution is global. So all of those benefits allow you to create like more economically viable and effective business. It just makes sense that over time, those that will tap into that technology will have advantage over the others. And this is what Larry Fink, the CEO of BlackRock, also says. He told The Economist last December that he has not been that excited about ledgers, so like in general accounting systems, since invention of double bookkeeping, which was invented 700 years ago. So he's extremely, extremely excited about what's happening in that space.
So since you said that we're really early in that wave, how can regular people and businesses take advantage of what's happening right now?
Brilliant question. I believe first educate. So watch those kind of interviews and many, many others, learning about what is the difference between Ethereum, Solana, Avalanche, so blockchains. What is a wallet, how to set up a wallet. Like crypto wallet, you can think of it in a simple term as like a crypto bank account. So you open it and then you can transact on chain. Try to understand gas. So this is something that is not so common for people to understand. On blockchains, transactions cost.
Yeah.
And many of the people are like, hey, but why would I pay for this transaction? And as I told you, it's early days for the blockchain implementation. So you can think of it as when smartphones were only starting, like they were actually pretty buggy. Like, you had like the UX was not so great, but over time it improved that much that right now our iPhones or like any other phone is actually as powerful as a laptop, right? So you can do almost everything over there. So it's very similar with blockchain technology. I would say right now we are at around 2005 when it comes to expansion of the internet in the blockchain realm. So it's a perfect momentum for learning and trying to get that osmosis because it doesn't happen like overnight. Second thing, I would recommend trying to do some simple position on Aave, Pendle, Morpho, so the biggest DeFi protocols. And it shouldn't be anything fancy. Let's call it $10, $20. So instead of going to buy like some nice thing in the store, just put it on chain and interact so that you understand like what's happening over there, like what is the whole promise about. And then be an early adopter within fintech applications. So I talk with largest fintech applications like weekly. Yesterday, I was moderating a panel with VP Vice President of Robinhood. And they just launched a chain, like Robinhood chain. And we can expect within Robinhood, Revolut, Prix, Stripe, PayPal, all of those financial applications, solutions that will be utilizing blockchain. So the earlier users will start interacting with those and trying to learn like how they work under the hood, the quicker they're going to get like benefits from that transformation.
Okay. Awesome. So since this convergence of like TradFi and DeFi is happening, what are like the key shifts that you're seeing in how banks, how asset managers in banks approach the on-chain adoption?
Yeah, I believe there are a couple of aspects that they take into consideration. The first one actually is a compliance and regulatory to ensure that any solution that is living on chain is according to the rules and compliant with any of the expectations. Second one is security. So I should not shy away from saying that in blockchains, we did have quite a few hacks. So because the blockchain system is open by its nature, so you can see all transactions, everything is open. So if everything is open, people can try to figure out ways to hack and attack protocols. So within last couple of years, we've seen a number of such hacks.
Yeah.
But the positive aspect is that we see less and less of them. So 4 years ago, there was way more than 3 years ago, there was less. And now it's like decreasing, like the frequency and the severity of those hacks. And eventually, I believe we are going to get rid of them like entirely. But as institutions, they are very wary of any of such incidents. Another one is actually data. So when you're thinking about, in example, commodities, in traditional finance, they trade 24/5, meaning between Monday to Friday, there is a market. And then sometimes in the afternoon, there's some other like second way of transacting on those commodities. But over the weekend, it's silent.
Yes.
And blockchains by nature are 24/7. So there's not a moment like anyone says to blockchain, okay, stop, now don't transact. No, it's just constantly ongoing. So you need to create methodologies for pricing those assets, for example, gold, silver, Forex, stocks, over the weekend as well.
Oh, true.
Yeah, and then we as RedStone are working with those data providers, brokers, and other entities that specialize in pricing assets to create bespoke methodologies that over the weekend work seamlessly and can help protocols to execute. And a tangible example is a platform called Hyperliquid. Over there, you can trade gold whenever you want, wherever you want.
Wow.
So you just open an account on a blockchain wallet and you can trade gold on Saturday, on Sunday, whenever you want.
Really?
And we as an Oracle are the infrastructure that powers the data and enables that kind of a revolution. And why is it important? Well, imagine a situation that on Saturday, somewhere in the world, a huge gold mine explodes. That means that probably people would like to exit the exposure of gold, or maybe buy more because there's going to be more scarce, whatever. It's like an information that is going to impact the market.
Yes.
And in TradFi markets, people will have to wait until Monday.
Yes.
Whereas in crypto markets, people can react to that immediately. So markets are just more timely and efficient when it comes to on-chain implementations.
I wanted to ask more about the risk, because for regular investors from TradFi, risk is like a very important consideration. And there is not only the hacking risk, but also like company risk. There were a couple cases in the past where just companies disappears or the funds were mismanaged. What can you say about improvement in that area, gaining trust to outside of core crypto audience?
Yeah, that's a very important aspect. I believe we are finally maturing as the industry. And I can see that very clearly from 2017 up until now, that the people that are doing business within blockchain ecosystem are more and more serious and are more and more transparent. And to give you a funny example, yesterday I was talking with an old friend in blockchain industry at Consensus here in Hong Kong. And he tells me, you know, Marcin, I can see this industry is going into the right direction, because 2 years ago at the conferences, you could see only maybe 10 people in suits and properly dressed up, and majority were just in t-shirts. Now it's over half of the room that are not necessarily always suited up, but let's say are presented properly. And I believe it's just moving towards this professionalism as it is in finance, right? Because you just need to keep up a certain level of standard, because money is a very trust-based aspect.
Absolutely.
So you need to be professional, you need to hold up to the highest standards, and you truly should showcase the users that you're the right person to interact with when it comes to larger funds. Another point is that 2-3 years ago, anonymity in crypto was something that was perceived very well as a founder. So you could be a founder, you would create a profile on Twitter and you would name yourself, I don't know, Donut123, and then you're a founder, right? And people trust you, even though they don't know your identity. Right now, there are very few founders that are not publicly represented, and it just creates more and more trust, because people usually trust the brands, but also the founders, like the people that are actually behind the organization. I think it's a very good movement as we see it.
Yes, that's very important. Like in other industries as well, the founder is the face. You want to know who's behind, right?
Exactly.
Can you tell us what RedStone does?
RedStone is an oracle. So we deliver data to on-chain applications. We are the second largest blockchain oracle in the world after Chainlink. Our clients include, for example, Securitize, which is the largest tokenization platform in the world from the United States.
Yeah, and we actually will have Graham Ferguson on as one of the interviewers for our podcast. So we will tag this video here.
Beautiful. Yeah, Graham is a good friend. Carlos, the founder, is a good friend. So
awesome.
Hi, everyone. We support BlackRock, which is the largest asset manager in the world, on their Bill fund, Apollo, Acred, Hamilton Lane Scope. We work with Spyco, Revolut, so household names globally. And as an oracle, we are mainly based out of Poland. So majority of our engineers are excellent developers like from that region. Our goal is to support the new generation of finance. So as blockchains become more popular and financial applications move on chain, we want to secure that. As RedStone, we ensure it with our token, which is the Red token that allows data providers within our ecosystem to stake the token and protect the network so that it's secure. And if there's any mispricing event from the data provider, we can actually slash it. So we created the whole tokenomics that allows this security to be at the highest standard. The token itself went live a year ago, and it's live across Coinbase, Binance, and many other exchanges, which showcases confidence in that. It's actually a funny process to ensure that an exchange is confident enough about the project to list a token. And recently, we also acquired a company called Credora, and we expanded into risk ratings. So similar to S&P or Moody's,
Uh-huh.
we give a rating between D to A to specific crypto yield strategies and vaults and DeFi applications.
Oh, very interesting. So where is this information accessible? Can someone, just like a regular observer like me, find your risk ratings?
Yes. So if you go to Morpho right now, for example, or
Mhm.
Spark, those are the two applications that we integrated from the very beginning. And if you go there, you're going to see a rating for specific strategy.
Mhm.
And why it is important. In November of last year, there was a huge crash of Stream Finance. It was a financial application that was taking leverage position, very aggressive ones in
Okay.
finance in general. People deposited, as far as I remember, about $400 million into that application, and it went to zero. And the problem is they were offering, I believe, 15 or 20% yield, like on a year basis,
Yeah.
but they were never talking about the risk associated. And there was
Okay.
not a party that would give like a very simple to understand risk score to them. And this is where Credora comes in. Imagine you have Stream Finance that offers you 15%, but gets a D rating, which is the lowest one.
Yeah.
And another strategy that gives you 8%, but has an A rating.
Oh, yeah.
Then you would ask yourself, okay, is it worth to take that risk to actually deposit that money and potentially lose everything that you have? Or maybe it's
Yes.
better to play safe. And here an interesting fact is that vast majority of the population globally are risk averse. So they prefer not to take extensive risk, especially when it comes to financial area.
Yes.
So we want with Credora to pursue our mission of making DeFi, we call it risk aware. So if you want to take high risk, that's okay. That's up to you. But we just want to make sure you are informed about the risk that is associated with specific strategy.
Yeah, you can make the conscious decision, right?
Exactly.
Yeah, it's not a surprise. When institutions look at tokenization today, do they mostly see it as a way of making existing processes more efficient, or are they already thinking about like entirely new financial products?
In my opinion, there are actually those two verticals in crypto and on-chain finance. The first one is taking well-existed and performing strategies from traditional finance and moving them on-chain. And simple case for that, first, remittance. So you want to send money from place A to place B. In crypto, it's faster, cheaper, and basically 24/7 as you want to execute that. So that was the first case that happened. And that was present with first Bitcoin, but Bitcoin was very volatile. So people created stablecoins. So tokenized dollars, Tether USDT, Circle USDC. Now we have over 200 stablecoins. And market capitalization of stablecoins right now is at about $300 billion.
Wow.
And I believe by end of this year, 2026, we are going to see already over $1 trillion.
Wow.
I believe we are going to cross 1 trillion. Then we saw exchange. So people exchange on, for example, NASDAQ, like dollars to stock and many other like assets. So Uniswap was the first decentralized exchange that was created on chain. And then we were going further, lending, perpetual markets, options, now ratings, for example, as we create with Credora. It's not a new concept. In traditional finance, you're sometimes even legally obliged to get a rating from S&P, Moody's, or Fitch. Those are the three biggest rating agencies globally. So we also try to take the good approaches from them and bring it on chain. So this is, I would call it, as we were talking, the maturation stream of on-chain finance and DeFi. So taking good, fundamentally sound logic and implementations from TradFi, put it on-chain rails, and make it just more efficient, instant, 24/7, global, and accessible to anyone. And then the second stream is creating new primitives. So creating absolutely new protocols and solutions that are not accessible or possible in traditional finance. And to give you tangible examples, the first one is staking. So you can stake ETH, SOL, so you can stake the native currency on a particular blockchain. And then you also have the primitive that's called liquid staking. So you can go to a protocol like EtherFi with your ETH. So imagine you have ETH, which is the native currency of Ethereum. You go to EtherFi, you lock it with their protocol, and they are going to give you, I believe right now it's about 2% yield yearly. And this 2%, that's very interesting, is not from the dollar value, it's from the ETH value. So imagine today you have one ETH that is worth $1,000 for simplicity. You put it into EtherFi, you wait a year, and then that position will have 1.02 ETH. So the 2% is calculated based on ETH, not the dollar value. And then depending what ETH is worth at the end of that period, that's your, let's say, payout in dollars. So if ETH appreciated to $2,000, then you're, of course, very happy. If it dropped 10%, ultimately against dollars, you're down. But you can imagine having a similar primitive in traditional finance if you were able to, we call it stake Tesla stock. So imagine you have a Tesla stock, you want to hold it for a long time, and you will be able to lock it to get additional Tesla stocks as you lock it. So it's like a very interesting primitive that is not present in TradFi, and on-chain finance is something very, very common and popular. Another one, there are a few, but another one that I think is a very important one is perpetual DEX, which is in TradFi, a very popular concept are options. Options market is one of the largest globally. On-chain, there is this new primitive called perpetual, which is, for simplicity, an option market, but without the expiry. So when you do an option, you always have the expiry date at which the option can be settled. And when perpetual market, you just open a position that goes in perpetuity. That's the reason it's called perpetual. And you continuously pay something that's called the funding rate, or you're being paid depending on which side of the table you're at. So if you're on the one that is smaller, then you're being paid. If you're on the one that is bigger, then you pay for such position. So coming back directly to your question, I believe institutions first will want to explore as much as possible from the first stream, because that already works and you can make it just more efficient. But ultimately, the biggest winners can actually be those that are going to innovate on new solutions.
Yes. So with the examples that you mentioned, like with staking or perpetuals, where regular users can take advantage of those today?
Blockchains in general are decentralized, so anyone can run the ledger and register new transactions over there. And those that are running it on Ethereum are called the validators. Those validators, for running the software of ordering the transaction on Ethereum blockchain, are getting paid in ETH. And for them to join the network, they first need to stake ETH. What it means? It means that you have to have, I believe right now it's 32 ETH. You lock it, and only then you can start becoming this validator in the process. And why would you stake this ETH? Because being a validator is a very important role. And you can try to be a bad actor. You can try to write some transactions that are not true. Like, for example, you write a transaction that you are getting $1 million, right? And then you try to propagate that to all the network. This is like a bad actor, and people are going, like, it's actually software right now, but other participants are going to see that. And if you try to do something like this from this 32 ETH that you have, you're going to get slashed, for example, 10%, 20%. So it just incentivizes you to play according to the rules. That's the reason right now in Ethereum, there's almost no slashing, because everyone has this stake. So they have financial incentive to perform well, and they know they are going to be spotted right away. So that's the reason Ethereum is so safe. And this liquid staking that EtherFi is offering allows EtherFi to offer your ETH to the validators in a sense. So it's essentially making it more accessible. So right now on EtherFi, you can stake as little as 0.1 ETH, and being a validator requires 32 ETH. So what they are doing, you can imagine they're just creating a pool of people that are going to give smaller amounts of ETH so that they can stack it up and give it to others to run those validators with 32 ETH. And when you give them this ETH, and by give, I mean, you just lock it with them and you can always redeem. So it's not, it's not theirs. You just lock it as in a bank. When you give it to them, you're earning this yield for that lockup. And then the perpetual exchange. So there's plenty. The one that we like the most is Hyperliquid. It's one of the most popular projects globally right now. They are worth like a lot of, their token is worth a lot of market cap. you can just go to Hyperliquid app, you create a wallet, and then you can create those long and short positions on ETH and BTC. I highly recommend first to watch some videos, like how to do that. If you're not a trader, if you're a trader, you're going to be probably fairly familiar because the interface is fairly simple. But if you've never traded, it's good to watch first some tutorials, not to burn your fingers.
Okay, sure. Yeah, absolutely. So you mentioned a lot of partnerships that the RedStone did in the past, like Securitize, BlackRock, and others. Can you actually tell us how these partnerships come together?
Of course. So Securitize is a tokenization platform. What they offer is taking a strategy, for example, Treasury Bill fund or private credit or reinsurance, and tokenizing it on chain, meaning that the access to this token, to this strategy, is absolutely global and for anyone who is going to go through their process. Now, if you tokenize a Treasury Bill, every day it appreciates in value. So imagine today you have $1, tomorrow you have $1.001, the next day you have $1.002, and so on and so forth, as an example. So you need that price and market value to be updated on chain. So this is where RedStone as an oracle comes in. So we monitor that appreciation in value and we deliver it on chain. So we were the first people in the world to create something that is called real world asset looping strategy. And now let me walk you through that. Private credit is a part of finance that allows people to borrow and lend money to each other without interference of a bank and then earn yield on that. So imagine a simple example. You're a railway constructor in Hong Kong and you say, hey, I want to create new railway next to the city and I need for that project $1 billion. You go to a bank tells you, well, I don't believe in that project. I'm not going to give you that line of credit. So then you go to a private credit investor, you present him a business case, and he tells you, okay, I'm going to give you the $1 billion, but you're going to pay me 12% interest. You're like, okay, and you estimate that you're going to make 20% return on that investment. So for you, it still leaves you with 8%. It's a good deal. So what this private credit investor can do is, similarly to this EtherFi, they can offer small pieces of that loan to invest to other investors and then earn yield. So this originator earns, for example, 12%, and he can offer to others 10%, so that he still earns 2%, even though it's someone else's money. Now, you can tokenize that product. So you create a token on chain and people can invest with USDC or any other stablecoin into that particular strategy and earn, for simplicity, this 10% yield. Okay, so you have this, let's call it one token that generates 10% yield. You can put it into Morpho, which is a lending protocol, as collateral. So you lock it in Morpho, and then you can borrow dollars, USDC, against that. That's a loan. Now, I know it's finance, but it's actually pretty interesting. You borrow USDC, and for borrowing this USDC, as in any bank, you have to pay interest. And that interest can be, for example, 5%. So now you hold something that gives you 10%, you borrow dollars against that, and you have to pay 5% for what you've borrowed. So you have an arbitrage of 5% premium, essentially. Now, it's called over-collateralized lending, so you can borrow less than you lock. So you lock, for example, $1 million, and you borrow 500,000, right? So that your position is not liquidated. Now with this 500,000, you can go again to Securitize, buy additional tokens. It's called, for example, ACRED or Scope. Those are the products from private credit they have. You buy that product and you create another loan. And this time you buy it for $500,000. You create another loan with 10% yield and you borrow dollars again, this time 200,000. And you do it again and again. So that's the reason it calls looping, because you do this kind of like a loop to increase your exposure. And with that system, instead of having exposure to only 10% of yield, you can end up having 17% or 18%. So effectively, you're just increasing your yield with keeping the risk structure fairly similar. So it is a bit more risky, that's for sure. But it's within the same heterogeneous risk that you accepted in the very first place. We as RedStone ensure that this ACRED that you delivered to Morpho is priced correctly. So every 24 hours, we are going to deliver the price of ACRED to the on-chain environment so that Morpho knows what's the value of the collateral. And if ACRED would start to go down as in the value, your position can get finally liquidated. It has never happened, but technically it can. So we are, again, this oracle and price transmitter. And this is what we want to create long term. We want to be this ultimate layer for global finance, delivering any data that people want together with risk intelligence right now with Credora. So the mission is actually pretty ambitious.
Yes, it sounds fascinating. I will keep my fingers crossed.
Thank you.
And so, what do institutions look for first when they choose their infrastructure partners?
Yeah, that's a funny story. When we were chosen as a primary oracle for Securitize, actually their partners, so BlackRock, Apollo, did a very, very extensive due diligence on us. So they were looking at the technology, who we are as people, what's our experience, what's our track record, what is our security assumptions. So they did like a very thorough background check on everything that we are doing. And I am very happy to say that we passed with flying colors.
Awesome.
So they said that they see absolutely nothing to be worried about. And that's how we started cooperating. Whenever we interact with those institutions, I can tell you there is one thing they care about the most, which is trust.
Yeah.
Trust and a brand. So they would prefer definitely to skip a project if they feel that something can be shaky in the future. So they're always playing on the safe side. So in order to gain their trust, you just have to showcase consistently like an excellent track of record. And as RedStone, I'm very happy to say that we are the only player on the market that has never ever had a single price manipulation or downtime event.
Oh, wow.
In contrast to, for example, Chainlink. Chainlink is bigger than we are, but they did have some smaller hiccups on the way. And those institutions really appreciate that we have this stainless track of record, and we are working very hard to keep it up. So as I mentioned, we have majority of our company are engineers to ensure the product that we deliver is actually of the highest quality. And they are based in Poland. Poland is very known for excellent developers and is actually a very growing country. So I would say from institutions, this trust. And actually the second aspect they care about a lot is customization. So they come to you and they tell you, hey, this is how we want this project to look like. And if you're, as a provider, going to tell them, well, no, we cannot deliver it exactly like this. We can only deliver it according to our procedures. They're going to be, okay, but that requires a lot of changes on our side. So if you are able to actually adjust to their particular expectations, and this is what with RedStone we shine. So we are excellent partner for customizable solutions. They appreciate that a lot because then you're showing that you're the partner that takes an extra mile in order to deliver what they would actually really would like to see.
How big is RedStone?
Oh, wow. So as a company, we are over 50 people right now. We are global in terms of the team. So we have people in the United States, Europe, Asia. So absolutely all markets out there. Majority of our clients are in the US and Europe. We are now expanding more and more within the Asian environments. We protect over $8 billion.
Oh, wow.
So it means if RedStone explodes tomorrow, $8 billion would be at risk. It doesn't mean it would disappear, but it would mean that they would be prone to being stolen or protocols would be prone to being attacked. So a lot of people actually trust us. We have over 200 clients currently, B2B, and support over 110 chains, including Ethereum, Solana, Stellar, Ton, Avalanche, and plenty others. So we are actually very happy with the pace of growth. We are growing our revenue. We are growing our expansion and exposure. Recently, we acquired two companies. One is Credora that I told you about, and the other one is called Security Token Markets, which is a US-based entity dealing within institutional finance and tokenization. We organized a conference in New York City in June in the Glass House in New York City. That's a pretty prestige venue. It's going to be mainly about tokenization and institutions going on chain. We invite people from JP Morgan, BlackRock, Citi, Goldman, so the big financial institutions out there. So I'm actually very, very happy about the progress that we've been doing.
Wonderful. Sounds really good. So let's talk more about data because it's critical for the financial institutions. Can you tell us what kind of data actually financial institutions care about that traditional Oracle setups don't struggle to support?
Yeah, interesting question. I would say right now they care a lot about the rates. So what is the actual interest rate in various countries, especially in the United States, but also like other regions. Recently, US Department of Commerce also expanded into blockchain, delivering GDP data on chain. So about the growth of the economy. We are many times asked about commodities. So as we recorded, past month has been one of the most volatile on the gold and silver market in the history of those markets. So it was going up and down 20% within like a couple of days. So it was truly a roller coaster. So we got a lot influx of requests about those kind of data types. Sometimes we are being asked about specific stock companies in, for example, Korea, sometimes even in Poland and the European markets in general. So I would say the type of data is very, very diverse. And as we go more with those institutions, I expect even more interesting and sophisticated use cases to be created. One that a lot of people talk about but has not been developed yet is Forex. Exchanging like currency globally. Right now that market is somewhat inefficient, and the blockchain technology can help to make it even more accessible globally.
Yeah, actually, to talk about that, you mentioned there is like Tether, USDC. Are there also stable coins for other currencies so you can actually trade them like Forex?
Yes, they are. So there is a Euro stablecoin, for example, URC. There is a Pound stablecoin. There's Korean Won stablecoin. Hong Kong dollar stablecoin. I also met people building that. So eventually we are going to see all of those currencies being tokenized, because a stablecoin is nothing else as tokenized version of a fiat currency. And we are going to see this Forex happening between those tokenized versions on chain, right? Here I have an interesting side story. In December of last year, Paxos, which is a custodian company helping to mint stablecoins, mistakenly minted $300 trillion of PayPal USD, PYUSD, which is double the size of global GDP economy. Which was pretty funny. So that happened only for half an hour, and we call it in our industry fat finger. So it wasn't like a glitch or like a mistake of the system. It was like a person that just typed wrongfully in the system, which also showcases there are going to be some edge cases, and we need to be ready like how to solve that. In that particular case, it was nothing serious. They just burned it like immediately. But just this sole information that Paxos did that small glitch was a pretty interesting one.
Looking a few years ahead into the future, what do you think a successful convergence between traditional finance and decentralized systems will look like?
That's a good question. So today, over 60% of tokenized assets, so real world assets, are yield bearing. Meaning that if you hold exposure to them, you're earning yield as the time passes. And those examples are treasury bills, private credit, reinsurance, trade finance, factoring, and many, many others. The other side of the system are the tokenized assets that are mainly for trading. Those are gold, silver, Forex, stocks, and so on. As we go forward, I believe both of those categories will grow enormously, and oracles will play a really important role in the first category to price this yield properly, so as they appreciate in value, and on the other one to deliver the feeds according to the 24/7 markets. As I was explaining before, these markets never sleep. And then if both of those areas keep on growing, people will want to utilize those tokenized assets in DeFi. And this is actually the convergence. So you can imagine having a Tesla stock being tokenized on chain. And then you go to, for example, Morpho, you put it as collateral and you can borrow against this. So similar as I was telling you about Acred, if you don't want to exit your exposure to a particular stock, you can use it as collateral and extend, it's called a line of credit against that. So I believe this more of those interesting financial applications will become more and more popular globally. And one thing I'm extremely certain about is eventually regular people will not notice that they are using blockchains. So this concept as gas, wallet, all of that will be abstracted like slowly but steadily. And then the adoption of those technologies will be invisible. People will be just using that, not even noticing that it's happening. And we as RedStone want to be this infrastructure that powers that, like silently. And on the Credora side, helping people to choose the allocation that they are the most comfortable with when it comes to risk aspects.
Okay. Awesome. Thank you so much for this discussion, Marcin. This was like really insightful. So if you enjoyed it as much as I did, please follow Marcin on LinkedIn and on X. He publishes regularly. Follow RedStone and subscribe to our podcast for more episodes like that. Thank you.
Thank you very much for the invitation. It's been lovely to be over here. On X, it's Marcin RedStone. On LinkedIn, feel free to reach out to me. And I'm really excited about this industry to keep expanding. Cheers.
Awesome. Thank you.